Hi, everybody, and welcome back. I'm going to start a series of sessions here talking about trading strategies and the importance of them to our trading. And one of the key things I want to emphasize is how different we can trade, and not to be falling into what I often call one-dimensional trading, which in itself is a valid trading strategy, but just to help showcase that there are lots of other things that we can be doing in markets. So really, what are trading strategies? They're tools that traders can use to manage risk levels and expectations for any given trade idea that we want to put into the marketplace. Every market and every trade has its own unique circumstances. When we get up in the morning and we feel something's going to happen, there'll be different levels of volatility. Markets will be reaching different points on our charts, which may change the way we want to trade, whether it be more passively, aggressively, all those kind of things. So that's why we look at maybe taking an individual approach to our execution and implementing some of these different trading strategies. Now, what can this help us do in terms of, appropriately applying different strategies? Well, it can certainly fine-tune our trade execution. As we go a little bit further around this wheel here, there are varying levels of complexity in the trading, and that requires more planning. And, very often as we plan our trades and we plan the execution, we're certainly looking at specific levels. For me, once I feel I'm going into a trade knowing, what the outcomes can be, and they're clearly defined, then I feel a lot more comfortable in what I'm doing. It helps me manage my emotions a lot more. I tend to know what's coming, and if things do come around the corner that maybe surprise us, I have a strategy against that as part of my overall trading strategy. So it will help us keep on a more even keel. And it will certainly help improve our trading discipline because we know literally what we should be doing at each level as part of this pre-planned strategy. So on the left-hand side, very briefly there, I won't go through them all. These are just names that we've applied to various trading strategies. They're not from a textbook. Hopefully they simplify and explain what we're trying to achieve out of any of these given trading strategies. And tonight I'm going to focus on the two in yellow, binary trading and zero cost trading. So what do we mean by binary trading? Well, effectively, this is the most simplistic form of trading. And right from the outset, a less experienced trader would certainly trade in this manner. And, it is a very, very valid trading strategy. What is the aim? Well, it's the same aim as we have with all of our other strategies. But the key element here is we are simply there to make a profit from moving markets. How is it done? Well, quite simply, we buy or sell at a single point of entry. Invariably, as traders, we have a go-to amount of risk that we will just throw into the market, which in itself shows a bit of inexperience and that one-dimensional side of us that I was talking about. But then the next thing we should be doing is placing our stop loss. We should be looking from the point of entry as to where we don't like that trade. So again, pretty simplistic. We get into the trade. We know where we don't like that trade, so we should be placing our stop loss there. And then after that, we can consider what is generally a single point of exit, that is our take profit level. So pretty one-dimensional. It's very, very binary. Why is this good? Well, if we execute it properly, it is the simplest form of trading. And the great thing is it can be implemented across all timelines. What do I mean by that? Well, it's the duration. We can be in and out of trades within minutes, hours, days, weeks using this trading strategy. So it's a bit of a one-size-fits-all, and it certainly can work. What would be the considerations for implementing this type of trading strategy? Well, it's a pure win-lose trade. And your emotions can get extremely high because we can't guarantee that our first 2, 3, 4 trades are all going to be winning trades. Let's say it was the other way round. And so by definition, if we lose our first 3, 4 trades, our emotions will start running a bit high. Our bank balances are getting a bit low. And particularly if volatility comes into the market, it makes this type of trading quite hard to keep putting your toe back into the water. So there is that side of it. It doesn't have too much defense to it as such. And discipline really is key, because what happens is if you continue to trade on a binary basis, your disciplines may start slacking a little bit when markets continue to go against you. And that's when we stack up bigger losses, and that's not good for us as traders. So if we move maybe one simple step further in terms of complexity of our order management, and we can maybe look at a zero cost trade. Well, what's the aim of that? Whilst it's still to take profit from moving markets, our goal here is to get ourselves into a situation where we improve the average entry level of our original trade. How do we do that? Well, as markets move in our favor, we cover a proportion of the original trade at a level that helps us keep part of our risk, and the average rate that we hold that risk will be at the level where we would be taking our stop loss. So effectively, if we get kicked out of that trade, having covered some of it at a slightly higher rate, we could lose no money at all. I know for a fact that I'd love to continually be in that situation where I cannot lose money on a trade, even if my idea goes wrong or the market pivots back away from me. So why is this good? Well, for exactly that reason. Even if you're out, it costs you little or no money at all. The pre-planning side of it, the calculation around where you may execute that first tranche of profit, provides a stronger platform for you, because you're actually looking a bit deeper into the market. Now, we know we're not always going to get this piece of business away, and so sometimes we will simply take that binary hit and take a loss straight away. We have to accept that's going to happen to us in the market. But I know for a fact, if I'm looking at different levels, if I'm trying to pre-plan this type of strategy, which isn't overly complex, it gives me a lot more confidence in what I do. And if I get that first tranche of business away, and I know I'm sitting comfortably in a position where I can't lose money, I can really start focus on the profit side of things. And that may make me look a bit deeper into it. It may make me a bit more patient, because I know I can't lose even if it goes wrong. And if I'm a bit more patient, sometimes that opens up avenues for bigger profit as well. There is that control side of things, and always, if I feel a bit more in control, I know I can keep my emotions in check as well. What are the considerations against doing this? Well, if the market goes straight in our favor and we do sell part of that position out, and the market then continues to go in our favor, we know we are sacrificing some of that upside potential, because we're giving some away cheaply as such. Don't get hung up on this, because we have to go back to what was the aim of this strategy in the first place, and that is to get ourselves into a no-loss situation. Whenever we try and achieve something like that that makes our lives better, we know there is a compromise. In this instance, the compromise is giving away part of your risk, but that only impacts you if it only ever goes in a straight line in your favor. So I'm going to try and showcase this, these two examples on a chart here. I'm going to pick up natural gas. We've got a situation here where the market has observed a 206.40 low and a 219.50 high. Now, let's say I did fancy this market higher, but I actually never got involved on that upward move. But I still like the fundamentals. Maybe I feel it's run out of a bit of steam and I don't want to jump in towards those highs. So now I'm thinking a little bit smarter already. I'm maybe being a bit more patient, and I'm thinking I want to buy on a dip. Well, for me, I look at this chart, and if I dip down towards that 210 level, that's where the market broke and accelerated. So I probably want to be buying just above that. So I'm putting a bid in there at 211.50. Clearly then, as I said, from a binary perspective, I then should be looking at where I don't like this trade. And clearly 206.40 has been the low for quite a while. So I should be looking at implementing a stop loss somewhere around the stop loss level at 206. Those 40 ticks are a little bit of insurance just in case there is a false break to the downside. I don't want to be getting involved in that. So I've got my entry level. I've got my stop loss level. Then I can start thinking about where I take profit. And clearly 219.50 is a high there I might want to take a look at. But it looks like there may be some evidence up at 228 from historic highs that there may be also an opportunity to get up there if this market builds momentum. So all I now have to do is wait. If the market never achieves that 211.50, so be it. I made that decision to wait. I just have to take that one on the chin, look at the markets again and go find my next trade. There's plenty out there. So, don't get upset about that. But in this instance, I got lucky. I read the tea leaves right. I was patient. I got some of this trade on board at 211.50. So my parameters are there. 206 is my stop loss. I don't even get time really to think about taking a profit because the market moves marginally ahead of me and bang, I get taken out. This is my binary trade. This has gone against me. I'm out at 206. The market has proved to me that I had the correct stop loss level because once we broke that 206.40, we went all the way down to 199.10. I did not want that pain down there. So pat on the back for putting my stop loss at the correct level. But again, the binary element of this trade meant because it went wrong, I'm out and I've taken that full loss between 211.50 and 206. Such is life. We know we're going to take those. But how maybe could I have changed things? If I look at exactly the same chart, exactly the same situation, but maybe implementing the zero cost strategy, there I am patiently getting my units in at 211.50. What do I then do now? Well, I still have exactly the same stop loss, 206, for the right reasons. I potentially can lose that 550 ticks. So how can I get myself long of units around about that 206 level? Well, if I take profit for 50% of my risk at 217, effectively the average for the balance would be down at 206. Now, please don't make this a science and work out that it's exactly 217, because if the market gets up to 216, 50, 80 level and starts stalling, that's probably where you want to be selling it. Don't hang yourself out to dry by waiting for 217 because it's an exact science to get you long at 206. The aim is to get you long at there or thereabouts. So it's a zero cost trade or very, very minimal loss. So that's where I'd be putting my offer in to try and take profit. And as I said, if I manage to achieve that, which the market does allow me, I know you're going to say this is contrived and I've got to showcase it somehow, but this did actually happen. These are real markets. You can see it happens. I've sold that 50% at 217. My average is now at 206. If I get stopped out, it costs me nothing. But now I've got that nice, comfortable position that I can't make a loss on this trade. So I can start focusing on my take profit area. I can maybe then start thinking about the 219.50 level. I can start looking at the calendar and spending a bit more time, investing a bit more time on my take profit levels now because I'm comfortable. Sadly, as we know, we follow the tape and we still get taken out. Again, pat ourselves on the back, stop loss level at the right level. What we've gained here is it's cost us nothing. I'd always like to be in that situation. Of course, if this had continued in a straight line and I did manage to be patient and take profit up there at 228, I'd only be taking profit on half the risk that I had because I'd given some away to achieve this zero cost trade. I tell you what, I'd be happy with that because I'm still making a nice profit. And maybe if I'd have had all my risks sitting there and I didn't sell some out at 217, maybe the size of my risk would have prompted me to sell somewhere below 219.50. I could have sold all my risk at 219.50 and then watched it go to 228. the mind does strange things with us when we have a lot more risk on. So there's still opportunities there, but the key factor from this trading strategy is that in a pre-planned manner, I've been able to get myself into a zero-cost situation, a nice, comfortable situation emotionally, where I can continue to look at markets and maybe other markets, knowing that this trade is fairly safe. We know we're going to get knocked out from time to time. That's what the market does for us. But this type of strategy can really help you as you trade, through the months and years.